Well, your pre-approval is in hand and you're out shopping for homes, or perhaps you've found a home and your loan is being processed. In today's episode, I'm going to share with you 5 mistakes to avoid that could kill your deal. You don't want to become one of those stories.
Welcome to the Utah Homebuyers Quest podcast with Nelson Bars. Our mission is to give you hope, knowledge, and encouragement on your quest for home ownership.
Housing affordability is at its worst point since 1986.
Higher mortgage rates are impacting Utah's housing market. Potential buyers out there being priced out.
It's getting tougher by the day to afford a home.
Many factors are making it very, very difficult with no relief in sight.
Homeownership may seem like an impossible mountain to climb in today's world. We're here to say that it is possible, and we're here to be your guide, to climb with you, to urge you forward all the way to the closing table. We believe in home ownership, and we believe in you.
Hello, home buyers. I'm Nelson Bars with Utah Independent Mortgage. I'm a mortgage broker here in Layton, Utah, and I help people buy homes, and I'm here to help you get ready. We know that it's tough, especially for first-time home buyers in our market. With prices and rates the way they are, it feels a little bit like climbing Mount Everest, and I'm just here to walk with you, climb with you, and help you. And I want to commend you for being here. As I always say, every episode you listen to is another step in your journey. And I'm blown away. As of today, we have about 550 subscribers to our channel, and I'm so grateful. And I just want to make sure you know my commitment to you is to keep bringing you helpful content that will help you succeed in your goal to be a homeowner. And if you haven't subscribed, I invite you to do so. Join us every time so that we can get you ready. I promise to inspire and encourage you, to keep you going, and to educate you so that you can get your best possible deal. Just a quick reminder, the first 3 episodes are base camp episodes, a great place to start to get a very thorough understanding of the basics before you dive into the topical episodes that come later. And also, don't forget, we have this asking for a friend section. If you have questions as I'm talking, feel free to head over to the website and record a little voice memo for the channel, and we'll play it on the podcast. Or if you just want to post your questions on YouTube in the comment section below, be happy to answer them there as well. Or of course, we have our Facebook group where you can hop in and ask your questions there too. So let's talk about today's episode. Don't kill your deal. Don't kill your deer. Don't kill your deal. We're going to cover 5 costly mistakes that you don't want to make. Just remember the work that you've done to this point to get your pre-approval, and the work that we've done. We've got your credit score fully calculated, and it meets the program's guidelines. Sometimes, however, you're just a point or two above the minimum. And if it goes down even a little bit, you might still qualify. It could make your payment go up. It could make the interest rate higher. It could make the mortgage insurance higher, or you might not qualify at all. Also, remember your income has been carefully calculated, and so have your debts, and we've established this debt-to-income ratio, but sometimes we're within a fraction of a % of the absolute limit for your loan program. Keep in mind as well, your down payment is soon going to need to be documented and sourced for the lender, and they want to make sure it's coming from an acceptable source. So all of your bank statements between now and closing could end up in front of the underwriter. And you don't want to do anything with your funds that would show up and cause concern for the underwriter on those bank statements. So we'll talk about that. In some cases, a pre-approval letter is a little fragile. Let's talk about what's at stake if something changes between the time we pre-approve you and closing day. If the financing falls through for any reason, whether it's the bank's fault or yours, you could lose your earnest money. Sometimes you're giving $1,000 to $5,000 or more in earnest money at the beginning of this process that's not refundable if your loan falls apart at the end, unless we're really careful about the dates and deadlines in your contract. Also, you've probably by then paid an appraisal fee or home inspection fees. You've spent a lot of time and energy shopping for homes. All of that would be wasted if your financing falls apart. And probably the worst part of all of this is that you could lose the house that you hoped to make your home. And if you do, it'll probably be quickly sold to someone else. And you can imagine being in this position where you've already given notice to move out of your current home, and then the financing falls through and you're scrambling. So I want to make sure I tell you these things so that you can avoid any mistakes, which unfortunately are all too common. So number one, let's talk about don't do anything that could affect your credit score while your loan is in processing or after you're pre-approved. Of course, the obvious thing here is missing a payment. Just make sure your payments are on time. But also adding to your credit card balances or opening new accounts, these can all lower your score. Now, we don't usually have to re-pull your credit during the process. The credit report that we started with is good for 90 to 120 days, depending on which lender we're working with. But what if we're forced to re-pull? I've seen underwriters say, hey, remove the authorized user accounts on this credit report and re-pull the credit so that we have a more reliable score. I've also seen underwriters say, there's disputes on this account. You need to remove the disputes and rescore the credit so we have a reliable score. Or I've just seen credit reports expire during the process because it took too long to find a house or to get to closing. And in those cases, we have to re-pull and totally rescore your credit. So anything that has changed now becomes part of your new score. We're kind of opening up a whole new can of worms if that has to happen. And what if your score goes down 10 or 20 points? What could that do to your loan? So my best rule of thumb for you is to operate as if your credit is going to get pulled again. Keep your credit card balances right where they're at or lower. Don't go open any new accounts. Don't close any old accounts. Just put everything on pause and be extra vigilant on your credit. If you have outstanding bills that could end up being sent to collections, make sure they don't, right? Work out a payment plan if it's a hospital or some kind of bill where you're having trouble making those payments. Give them a call, make a payment plan, protect your credit. Be hyper vigilant about your credit during this phase. Okay. Number two, it's a little bit related to the first one. Don't take on any new monthly debt payments or open any new accounts. You need to know that your credit is being monitored by the lender who's processing your loan. And any inquiries, anyone who pulls your credit for a car loan, a credit card, or even another mortgage during this period, it will immediately trigger a question from the underwriter. They'll want to know, did you open an account? How much do you owe? And what's the monthly payment on that account? And we've seen a lot of this, like furniture stores is a really common one. And I think it makes sense, right? You're about to move into a new house. You need a couch. There's a big sale down at RC Willey this weekend, so you want to take advantage of it, and they're offering 0% financing. So why not open an account? Well, that inquiry will show up instantly from the credit monitoring service that the lender uses, and we're going to be forced to address it. And say we find out that the new monthly payment is going to be $150 for your new couch. We have to add that to your debt-to-income ratio, and it could be a problem. And I've also seen this a lot with car loans. Imagine a scenario where you get in a car accident, your car gets totaled during the loan process, the old loan gets paid off, and you need a new car. Honestly, I've had some clients call me during the car process or the house buying process and ask permission if they can buy a new car. And I actually love this because nobody wants to jeopardize your home purchase. So I love that you would be vigilant and careful and give me a call. And I'm always happy to open up your file and take a look. And oftentimes, the debt ratio might go up 5%, but that's still well within the loan guidelines. And so I can tell you to go ahead with the purchase and send me the statements so we can document the new payment in your file and just keep moving forward. The bottom line is just don't do anything that will affect your debt to income ratio. They will find out, and it could kill your deal, especially if you were already right at the limit, if we were already going at the maximum for what you could qualify for. Okay, so that's tip 2. Number 3, don't do anything that could reduce your income or make it appear less stable. So if you're offered a raise, go ahead, take it. Great, right? Of course, you would want to do that. But if you're offered a new job, we might want to talk about that before you take it. Sometimes it's fine, but if the new job is in a different industry, or let's say that you're taking a little bit lower salary, but now you have the opportunity to earn commissions, or the bonus structure is really attractive, or even if it's just variable hours and you're not guaranteed a set amount of hours per week, all these things will make the underwriter worried if your income is stable. And they could just disregard it completely and disqualify your income, which could kill the loan if you move from stable employment to something less stable. Another scary thing is If the new job starts with a probationary period, it just doesn't count. We can't close if your job isn't permanent, and we're relying on that income to qualify, right? So any of this kind of stuff would probably cause an underwriter to pause. Often I've seen them say they want you to work the new job for 6 months before they can count it towards your qualifying income. Also, you would think it goes without saying, but don't quit your job. The lending team has employment verifiers that work in their closing departments. They will always verify your employment before they send the closing documents to the title company. And also, sometimes they'll verify your employment the next day before they send the wire to finalize the deal. So what if you give 2 weeks notice before closing? You're technically still employed at the time of closing. Well, one of the questions they're going to ask your employer right at closing time is, how likely is your income to continue? And if they say, oh, well, this is his last week, then the deal is off. They will not fund your deal. And all those bad things that I laid out at the beginning of this episode could happen to you. Incidentally, this isn't something that I'm going to help you conceal. If I'm aware that you're quitting your job, I have an obligation to not deceive my lending partners. So let's just stay employed. Let's avoid any of that fraud. Now, number 4, don't pay anything related to this transaction with cash. And don't make any large cash deposits in your bank account so you can pay for it with a check. This is especially important with earnest money, appraisal fees, anything that's supposed to be part of the closing. That funds all have to come from a verified and acceptable source, and cash is not one of them. So if you take cash from your safe at home and deposit it into a bank account, the source cannot be verified. There's no way for you to prove where that cash came from. And then if you use that for earnest money, it can be super messy. I mean, you've probably been told that earnest money counts toward your down payment at closing. Well, not if the source of that earnest money is cash. Not if it can't be verified as coming from an acceptable source. So in cases where we've had clients do that with cash, we've had to basically ask the title company to give it back, or we just ignore it completely, and you'll have to come up with more money, not counting the earnest money on closing day, and then it works out fine if you're able. But just don't pay your earnest money with non-verifiable funds, or even maybe a few more warnings. Don't use anything that would not be allowable. Like I've seen clients get a check from their mom to cover earnest money, or from a friend, or from a business account. Those things may or may not be an acceptable source. If it's coming from a parent, they can get a gift letter. A friend's not allowed to give you a gift, right? And if you're draining your business account, that could throw your income into doubt in the underwriter's eyes. So please, unless it's just coming out of your savings account, give me a call. Talk to me about it first before you submit the earnest money, and let's just make sure it's acceptable. Now, down payment funds, let's dive in a little more. Just so you know, down payment funds are going to be scrutinized. They're going to ask for 2 months of bank statements. Anytime they see a large deposit on the bank statement, which is defined as more than half your income, then they're going to ask questions. They're going to ask you to source it and season it. It has to be there, and it has to be sourced. So cash just needs to stay out of the picture. If you have cash that you hoped to use, give me a call and let's talk about some alternative game plans. I've had some clients who've been able to take the cash and use it elsewhere so that their income between now and closing that's coming from an acceptable source can accumulate in their checking account. So we got ways we can get around it, but we really need to be talking about the source of your earnest money and the source of your down payment. Okay, so instead of just tip number 5, I'm just going to roll off a fast list of bonus tips. I've got a handful here, so let's do this. Don't ignore your email inbox. Lots of people, from your agent to our processing team to the lender and the title company, will communicate with you via email during this transaction. You need to check your email every day. And if that's not you, if that's not possible for you, consider putting your spouse down. If he or she is better at checking the email, put them as the main point of contact, or at least give us a warning. Hey, I'm not real good at email, so if you send me something that needs to be signed, I'd love a text so that we can keep this thing moving forward. Also, don't assume that if we ask for a document from you that you have a couple days or weeks to get the items for us. We really cannot get behind schedule or we're at the mercy of begging other people like appraisers and underwriters and title companies or the lender to rush your file. I always say to my team, we're going to rush and press in the beginning so we don't have to beg other people to rush and we don't have to stress in the end. So work with us fast, respond quickly, same day if possible, to all requests from the processor or the title company or your realtor, anybody like that. Another one, don't co-sign with anyone else on any loans. That's going to show up on credit as well, show up on the credit monitoring, and we already talked about all of the damage that could come from that. And then lastly, don't leave me out of the conversation. I've already said this a couple times, but if you're changing something, especially when it comes to closing dates or asking for more money from the seller, anything with employment income, let me know or my team and let us weigh in. Things will just go smoother because we can help you stay within the loan guidelines, right? Okay, so there you have it. Those are the do's and the don'ts, so you can keep your pre-approval squeaky clean and help us get you all the way to the closing table with low stress. As we wrap up this episode, if you found it valuable, please hit the like button. It really helps me reach other people just like you. And if you want something even more valuable, I encourage you to visit my website, homebuyersquest.com, and book a consultation with me. It's totally free, and the whole conversation is directed towards your specifics. So I think you'll find it a lot more valuable than even this podcast. I actually had the honor of meeting this week with a podcast listener and her husband, and they've listened to she's listened to every episode, not her husband, but every episode, and already done great work bringing their credit scores up. It was such a joy for me to sit down with them, and they're really just a few steps away from a pre-approval, and I'm here for that. We met, we discussed a couple of items that were pertinent to them, things that we haven't talked about on the podcast, and they know exactly what to do. They know their exact next step, and we're going to work together until they're ready. And that's the goal. That's why I do this podcast. I hope to do the same for you. I would love to show you what your exact next step is, no matter how far away you feel from homeownership. Okay, well, there you have it. Thank you for listening, and I hope we can do it again soon.
Thank you for listening to the Utah Homebuyers Quest podcast with Nelson Bars, your place for a strong dose of inspiration and knowledge so you can stay on top of your quest for home ownership. If you have a question or comment for the show, we'd love to hear from you. Visit homebuyersquest.com to record a voice memo or submit your question. You can also join our Facebook community to interact with experts and fellow travelers. Search Homebuyers Quest on Facebook to find the group and join the conversation. But with just a simple click to subscribe, we'll invite you back to the next episode. And remember, we believe in home ownership and we believe in you.